For more on the rally, let's bring in Stuart Kaiser, Citi's head of equity trading strategy. Stuart, great to have you with us.
Thank you.
What did you make of this rally? Is it a game changer?
I mean, we think the news over the weekend was a game changer. We've basically been slowly trimming tail risks, I would say, for the last 2 to 3 weeks. And I think on the weekend, you went from trimming to chopping. And I think you cut off a significant amount of the tail risk. To your point, it doesn't mean you're out of the woods at all. I mean, our view a month ago was your near-term risk was to the upside on positive tariff news, and then your medium-term risk is kind of to the downside if you get, downward pressure on EPS and on GDP growth. I think the Fed will be happy about this. They wanted to wait and see, and I think this opens up some more space for them to wait and see. But look, the bottom line is in 1Q, two-thirds of S&P 500 companies basically punted and just left guidance where it is. How that resolves itself over the next 1 to 2 quarters is probably going to largely determine the direction of equity markets.
How do you think of, though, the trajectory of this market rally? Is there still room to the upside in that maybe we overshot to the downside when we were at 48, whatever it was? And how much of an upside shot is there from here?
Yeah, I mean, I think there's still room to the upside. I think if you're someone who's less positive and doesn't want to be long this market, would prefer to be short, those folks are going to step out of the way, and they're going to let the systematic buying from risk parity, from vol target, and from CTAs, play itself out. There's no reason to fight that. Those are emotionless buyers, and they're not fundamentally driven. So you let that play out. And how much is that worth? It's hard to know. On Friday, I would have told you it's probably worth a couple hundred points of S&P, a little bit less now. But again, every investor knows about these flows, and they're not going to get run over by them. They're going to be careful.
And I think we're getting some headlines now, even about tax policy. We're getting the first whiff of what's going to look like the White House is on to the next act. and again, leave the detail and the important detail and ultimately the impact of the economy on effective tax rates that I do think are going to be somewhat of an issue, but I think there's more goodies. And I'm just getting back to the market that we have here. And I'm getting back to a market that I think also, if we get some sense even coming out of earnings season, I think people can sort it any way they want about stabilization of earnings outlooks. You just said it. They kind of punted, but, some of these guys weren't as bad as it sounded because why should they have been positive? So where can we go? Throw some levels at us, because I think the market can continue to trade higher here.
Yeah, I mean, could you get the S&P back to 6,000? I mean, no problem. I think you could get there. To your point, though, tax and budget is a real and important negotiation. We highlighted that back in late March. Obviously, it got washed out in the news flow by tariffs. But, the bottom line is whatever deal they announce when the CBO scores it is going to look probably relatively, deficit expanding. And that could be an issue. We could get the long end of the bond yield curve moving higher. I think the risk from rates, to your point, lower 10-year on weak economic data, unequivocally, bad for equity markets. But I would say higher 20-year and out based on, inflation and policy risk is equally an issue. So, look, I would not try to step in front of this rally. I think you have to let it play out. I think it can run from here because the bottom line is most institutional investors captured very little, if any, of the rally we've had to date. We were half joking, but you only had to own the market for 60 trading minutes to capture the entire 17% rally off the low. The flip side of that means, though, if you didn't own it for those 60, you didn't capture much of it. So you're almost it's not a FOMO, it's a fear of I missed out. And the question I think now is, do we get engagement, another level of engagement to the upside, or do people hope they get a little pullback and are kind of aggressive dip buyers? So, I think there's more upside, but it's not a clean trade.
Everyone doing FOMO in their head. Is that a thing? So how much, though, of this rally today do you think was on what Tim talked about with the tax package? Because that's sort of been coming and percolating the last few days. And, that would be a positive. Yeah,
I mean, I think almost all of today was tariff. The market has largely been expecting those 2017 tax cuts to get extended. The question has the House wants to extend them, the Senate wants to make them permanent. But I think the base case for most folks is the vast majority, if not all, that is going to get extended. So to me, look, you went into the weekend, if you had polled clients, which we did, people were expecting, maybe we get down to the 50 to 70% range in a best case on China tariffs. And we come out of it at 30, 10 of which has already been announced, and 20% of which is fentanyl, which in theory could be rolled back pretty easy. So I think most of this was tariff driven. And if we get a good outcome on taxes, that's potentially another leg higher.